It is true that on Wall Street and among traders, there's a lot of endorphins being produced. And in fact, they've studied traders in the London stock market, London traders, and they found that sure enough that those who take on significant risks may have increased levels of testosterone. They found correlation between those with high testosterone and high risk taking, and also causation. Some studies show that if you take a nasal spray of testosterone, you're more likely to take financial risks. So it's not just in Wall Street, it's also in a lot of financial decisions when you're in a casino, right? Those who have certain chemicals are more likely to take certain financial decisions. Well, the most important thing about an investor is someone who can detach themselves from irrational activity. For example, one investor who I know went to Japan recently and looked at all kinds of banks and met companies and tried to figure out what should he invest in Japan. But when he came home to America, he decided he was not going to invest in Japan for 3 to 6 months. And why is that? Because he felt that he may be subject to the availability bias, meaning that the more likely you can recall something, the more familiar you are with something, the more likely you're going to invest in it. That's why people play the lottery. My dad plays the lottery every single week, and I ask him, Dad, why do you play the lottery? He says, well, I see people winning the lottery on the news. I may win it. And I said, well, you're not seeing all that, hundreds of thousands of people that are losing. So professional investors can create checklists to start rooting out their bias, whether it's things that they can easily remember or things that they're familiar with, and they can check themselves to make sure they're not making irrational financial decisions. Markets are very volatile when they're going down. It's because it encourages irrational activity. When you're losing money, some traders try to double their bets to try to make up their losses. So they don't realize losses. They want to keep on doubling down, doubling down. That's why you have these incredible trading losses, because some traders are just loose cannons and they don't want to lose money, they want to make money. So they keep on making irrational financial decisions. And that's why when the stock market gradually goes up and then it plummets when it goes down.